Let's start off with the average interbank rate. We saw that increasing to 22.7% from around 20.3% or so. What's interesting to note is this really signals a tight liquidity in the market. What is your sense with regards to what is occurring in the interbank market?
Well, the liquidity situation had started improving with the interbank rates going below 20% levels. But I think what we're seeing currently is some demand for monies, especially because of the festive season. But also there must be also corporates who are just trying to ensure that they're prepared for the beginning of 2012, hence the increase.
We also had economic data coming through for the third quarter. A number 3.6%. This is the slowest pace that we've seen since the end of 2009. It seems that there is a bit of concern with regards to the growth outlook going forward. We know inflation is a bit of a problem right now as well. And we're also looking at how the local currency, the shilling, has been performing. What is your prognosis with regards to some of the outcomes, the possible outcomes into 2012?
Well, inflation has really affected the current performance of the economy, especially food and energy costs. And we've seen the sector that has really taken a battering is the manufacturing sector, especially due to high operational cost and cost of energy. That's why we are finding that it has actually experienced an 80% decline compared to the previous period. And going into 2012, I think sectors that will continue to remain resilient are in construction and also real estate, which basically have shown that the decline, they're not experiencing much decline in terms of performance. But in addition, we've seen the rains coming through, so the food situation should improve. We're also seeing that the crude oil prices are more or less stable, so we should expect a slightly better 2012.
That's great news, Stephen. Let's just touch on this inflation number, which is sitting at just below 20%. And I remember actually at the beginning of the year where we saw the central bank actually cutting rates, saying that inflation is starting to look slightly better. We've got the key lending rates sitting at around 18%. So these are very high numbers, and they could actually dampen growth going forward. Do you think that the balancing act is now occurring at the right level with regards to ensuring that you focus on the likes of inflation, but you also take growth into consideration by ensuring that you do not hamper retail spending, for example, with regards to that high interest rate?
Well, from the data we are seeing, retail spending has definitely been affected because there's tight liquidity and money has become basically expensive, and people would rather keep the little coin that they have safely in the bank, or alternatively spend it on essentials. Now, of course, the central bank's role is to ensure that there's stability and sort of enhance some positive mood. That's why you hear them mentioning that inflation will be inflation will sort of stabilize and then rates should decline. But in the real sense, we've seen inflation still spiraling upwards. And of course, the economic agents will factor in inflation and rates will continue being at a high until such a point when we start seeing a downward spiral in terms of inflation.